Well, hi everyone. My name is Jennifer Duran, and welcome to the Worth and Wealth seminars. Today's topic is on debt reduction blueprint or creating a debt reduction blueprint, your guide to financial freedom. As a reminder, this webinar is being recorded. You'll find more detail on our disclaimer in the chat, but I also wanted to remind everyone that all materials, including the slides, supporting documents, and additional resources will be sent out to everyone who registered for the webinar, whether you're here now today or you couldn't make it. And that's the case for all of our webinars. Also want to remind everybody that once you exit out of Zoom, when the webinar is over, you'll have a very brief 5-minute questionnaire or survey, just asking you your thoughts on today's presentation or any other topics you'd like to see from us. We would love your feedback on that. And now, with further ado, I'll present your presenter for today, Jonathan Cafarella. He is a citizens representative, and I'll pass it on so he can introduce himself. Thank you,
Hey,
Jonathan.
everybody. Hey. Thanks, Jennifer. I appreciate it. Thanks for having me, everyone. So my name's Jonathan Caffarella. I work for Citizens Bank. I work as a small business relationship manager. So I manage an entire book portfolio of customers that I have for small business. And I cover about 20 branches as well to help answer all their questions with small business needs. Prior to that, I have been in the retail banking space for about 10 years. And this I've been doing for about 3 at this point. So been a good amount of time, have a big background of banking, finance, all those things. And looks like today we're going to be covering, debt, what it is, how to go through it, and things like that. So it's a little bit about me. I'm up in New Hampshire, but I help out however I can. So I am ready to share my screen, Jennifer, if that's good to go. I just wanted to confirm you're all right with that.
Yes, you're good.
Perfect. So, like we talked about, we're going to be talking about debt reduction blueprint. So, just a way to get your own financial freedom. So, basically, the purpose of this presentation is to understand debt, what it costs, and the strategies to repay it. So, I like to start off these presentations with what comes to mind when you hear the word debt. Um, and then, Jennifer, if you can share some of the responses, I'd love to chime in on those as well.
Totally. And maybe
I can
think,
start off with a couple examples for
yep.
myself, just
Mm-hmm.
so you guys have some. I mean, a big one that we see a lot of people have that, looms for a long time would be student loans. A very common one would be, say a car payment. You can have credit card bills. You can have a mortgage payment, rent. Yep.
Someone
Loss of
put
sleep.
loss of sleep. Yep. Oh, there you
Loss
go.
of sleep that's a debt on the body. So I respect that. I like that answer. Financial burden. Yep. So it can be a financial burden. So we're going to talk about how to make it not a burden and how it can be helpful as well. So perfect. We're going to move on here to the next slide. So what we're trying to do is understand the different types of debt, various forms, including bad versus good debt, and how it can impact on your personal finances. We'd also like to talk about, the cost of borrowing money from an institution. So we're going to go through that and what that looks like and how it's calculated and what lenders or institutions look for. We're also going to cover assessing your own personal debt, how you can calculate your total debt and use a ratio, which is your debt to income ratio, so you can evaluate your current financial situation. And lastly, not lastly, but one of the most important things of this presentation, we're going to create a debt repayment plan so we can explore strategies such as the snowball or avalanche methods to effectively manage and pay down debt. There's also debt relief options that we can cover, so tools that we're going to provide in this presentation or tips that you can reach out to if you have current debt and how you can lean on and work with people that may be holding that. And last but not least, we're gonna, talk about the healthy financial habits. So strategies to avoid debt in the future and maintain an overall, high level of financial health. Is there any of these that stick out to anybody primarily that they're looking forward to hearing about? All right. Those are two good ones to start. So we'll get there. We're going to move into the basics of debt. So, as someone said, they called it a financial burden. So, debt is money borrowed that must be repaid, typically with interest over a set period. There are different types of debt. So, we have secured, unsecured, revolving, and installment debt. Secured debt is backed by collateral, such as a mortgage or a car loan, so something tangible that is backing that. If there's any small business owners, there's other types of collateral that banks and other institutions will use, such as equipment, receivables, and other items there. But typically, this is something that is backed by a physical asset that whoever is lending you the money could then obtain and then resell if anything were to go astray with the loan. Unsecured debt, it's not backed by any collateral, and a good example of this would be a credit card or a personal loan. And that is just a contract between you and the financial institution that you will pay back that debt, but it's not secured by anything. Revolving debt allows borrowing to a certain limit with flexible payment plans. This also tends to fall into credit card or lines of credit, but a lot of lines of credit. So on the small business side, they'd be unsecured. On the personal side, a good example of this would be a home equity line of credit, which is kind of a mix of revolving and secured because it can still be secured by a property, but then it's revolving for you. And then installment debt. It's a borrowed as a lump sum and then repaid in fixed interest as a fixed term loan. So your payment doesn't fluctuate. You have it set. A good example of this would be a car payment. Now, we talk about good versus bad debt. That's something that I mentioned at the start of the presentation. So not all debt is bad. In many cases, when we borrow funds to purchase something that may gain value or help us generate income in the long run, that may be considered good debt. So, that being said, when we think about that, there are things over the time frames like a house. A lot of people will say can be good debt because then you have a tangible asset once it's paid off in the long run. A car, if you use it to help yourself make money, things of that nature. If you finance something and set your goals and pay it off in a certain amount of time with some of the credit card promotional offers, so you take advantage of those can be examples of good debt and using it correctly. Um, Bad debt, in the general scheme of things, the definition of that would be borrowing on items that depreciate or don't generate income for you. So items that would be depreciating, cars can fall back into this category. If you're trying to buy a car to hold on to it to then resell it, cars depreciate with usage. That can be an example of bad debt. Or if you buy something that you're incurring debt on that is specifically just to have and it's not going to get you any income in the future, that is what could come into the bad debt term. So when we move forward to the terms, it's we want to know these key terms when we talk about debt as we go through this presentation. So principal is the original amount borrowed. Interest is the cost of borrowing, usually expressed as an annual percentage rate or APR. Term is the length of time over which the debt must be repaid. And minimum payment is the smallest amount that can be paid each month to keep the loan in good standing. So, we have, I want to pause there. Does anybody have any questions on types of debt, good versus bad debt, or any of the key terms? And I want to make sure we're all good on the key terms because they're going to come into play as we go through this presentation.
No
All right.
questions. Yeah, at the moment.
No, perfect. All right, we're going to move forward then. So, we're going to focus on the cost of debt and how it breaks down. We have 5 things in total that go into this, and we'll go through each one. So interest rates are a big factor. Factors influencing rates, minimum payments, fees and penalties, and total cost of borrowing. So I just want to give you guys an example. If a as we know with credit cards, when you get your bill, if anybody doesn't have a credit card, what will happen is you get your bill, you have what's called your minimum payment that's due, and then you could pay your statement balance in full. If you pay the statement balance in full, meaning the principal and any interest that was accrued on there, it's all paid off, and then you have that full credit line available for for the next statement cycle. But say we only made the minimum payment, and let's assume that there's a $5,000 credit card balance on there at 18% interest, which is pretty close to the average interest rate on a credit card right now. If you just make the minimum payment, does anybody know how long it would take to pay off or have a guess? So the balance on the card is 5,000, the interest rate is 18%. And if you only did the minimum payment, 10 years. Okay, thank you, Marie. Any other 5 years? Thank you, Jeffrey. All right, we got two good responses in there. It could take over 20 years. So it could take over 20 years to just pay off $5,000. So I'm not sure if that's eye-opening to anyone or anything like that for minimum payments, but it could take over 20 years just to pay off $5,000 on a credit card if all you make is the minimum payment. So yeah, it's a very when you don't realize that, and when when we don't cover this, or people aren't financially aware of, they think they're just making their minimum payment, it can really be an eye opener. So let's talk about how debt is factored in, and what the fees look like. So for the interest rates, the cost of borrowing money expressed as annual percentage rate, or APR. We talked about that on the previous slide. Higher rates mean more expensive debt. So that 18% is a higher rate, but that's because it is an unsecured lending product that a bank is giving you, which tends to have a higher rate on it. So what influences rates? The credit score. Higher scores get lower rates. Loan terms, longer terms mean more interest will be paid overall. So if you have a higher credit score, FICO score, Experian, TransUnion, Equifax, that tends to give you a more advantageous rate on whatever product it may be. And then for your loan terms, if you have a longer term loan, you're going to pay more interest to the institution over the long haul. So for something like a mortgage, that makes sense, right? 30 years, 20 years. Sometimes we see people do 15-year mortgages. That makes sense that you're going to be paying more over time. But one of the things to factor in is you are paying more interest over time. We just talked about the minimum payments with that example. So only paying the minimum means more interest over time. And then when you pay extra, meaning towards the principal balance, which we talked about from the previous slide, that reduces your total cost overall, because you're reducing your interest expense on there. Fees and penalties. So late fees, prepayment penalties, and upfront fees can add to the cost. So if you are late on payments, companies can charge you a late payment fee for not paying the debt in a timely manner. Prepayment penalties, depending on the type of loan or vessel that you have for debt, if you pay it off early, and this will be outlined in the terms and conditions when you sign for the loan, they can charge a fee for that. And upfront fees, so like an origination, booking fee, closing fees, those can be part of the cost as well. So one of the biggest things that I recommend to everybody is, when you're signing any type of contract for whether secured, unsecured, debt, look at the fine print just to confirm that there aren't any of these fees, so you're not surprised if that happens. And then total cost of borrowing. Repayment includes both the principal, so the original amount borrowed, and the interest. And then an example of this would be a $1,000 loan at 10% interest adds $100 per year for a total repayment of $1,100. I have a quick question for everybody. Has anyone been surprised at how long it took them to pay off a loan? And did you have any takeaways from that experience when it occurred? If not, that's okay. We can move forward. I know we just did an example at the beginning too. All right. Debt to income ratio. So debt to income ratio, otherwise known as DTI, it's the percentage of your monthly income that goes towards paying debts. Lenders will use DTI to evaluate your ability to manage debt and qualify for new loans. The lower DTI improves your chances of securing loans with favorable terms. So how to calculate it? The first step, add up all your monthly debt payments, mortgages, credit cards, student loans, car payments, any personal loans, things of that nature. If you add all of those up to get your cumulative monthly payment number, that's your first step and what we want to do. Your second step would be to divide by your gross monthly income before taxes and deductions. So your gross income before they take out taxes and everything. And then step three, you multiply by 100 to get the percentage. Has anyone ever calculated their own debt to income ratio or have heard this term before? No? Okay. And then Jen, I can't see the chat right now if there's anything else. I saw the student loan, but if there's anything else that comes in.
Of course, yeah, we have one. Someone is asking to use an example. Someone
Sure.
said, it's hard to sit and look at all at once or look at everything all at once. But
Yeah.
I'm assuming in pertaining to debt and
Yep.
minimum payments or total balance question mark. So we have like two questions there. So an example, and then one
Yep.
is, yeah.
Yeah, so let's all do an example together if you guys want to do the math out and let's see what numbers that we get. So let's say the monthly debt payments, and by all means, just use a calculator to keep it clean for yourself. But let's say we have we pay $150 for a minimum payment on a credit card. We then pay $1,500 towards a mortgage. And then we pay $400 towards a car payment. So total debt that month would be $2,050. So we'll jot that down. So 2050 for monthly debt payments. We're going to then take that 2050 and let's say the gross income for this example is $95,000. We would then divide 2050 by 95,000. I'm sorry, I apologize. Grossly month income. So we'll say the monthly gross income is $8,000. So we'll take 2050. We'll divide that by 8,000. We then multiply by 100 for step three. So your debt to income ratio is 25.63 if we round up from that five. So about a quarter of your gross income goes towards your debt. That's a very broad, brief example, but that is how the calculation would work. Does anybody have questions on that?
Yeah, so I tried to, so 2050 divided by
Yep.
8,000
1,000.
gave
Yep.
25.6.
Yep.
And that is the
Perfect.
percentage of your income that goes to debt every month, essentially.
That is correct. Yep. Your debt to income ratio. Yep.
Perfect. I will
And then
send the same example in the follow-up email. Thank you, Jonathan.
awesome. Of course. And then Jen, could you just remind me the next two questions? I apologize.
Actually, so we have a follow-up to this. Is
Perfect.
25% considered good or bad? Is that too much?
We're we're going to get to that. So we
Oh,
have that in
okay.
some later slides. So we have that in some later slides. That's a great question. We're going to get to that.
Nice.
Mhm.
And another one was someone asked minimum payments or total balances, question mark.
That is completely determined on your situation. If you're making payments in full, say to a credit card, I wouldn't really consider, you can consider that part of your debt to income ratio, but you're paying the balance off in full, so it's not debt at that point. But say you're making more than the minimum payment. So if you were doing, instead of that 150 towards the credit card, you were doing 250, including some towards principal, if that was above the minimum payment, then you would want to include it that way. So it's whatever payments you're making per month towards your debt to calculate it, whether that's the minimum amount or if you're paying extra, and that's how you would go through the calculation.
Perfect. And also just another question.
Hmm.
The calculation uses gross income, so money before taxes. Is there
Yep.
a reason it doesn't use the net income, which is the money after taxes?
That's a great question. So when we're calculating debt to income ratio as a financial institution, they do it based off of your gross income before your when they calculate it. So knowing that you're going to have deductions and taxes and items taken out that way, they they do it just from the lending perspective to help make the decisioning when it comes to applying for things and your score and all those types of items. But if you want a more realistic number, you can use your net numbers as well. That'll give you a real time how you feel personally, what you have, which actually hits your bank account, and how much of it is going towards your debt. You can do it in that way. This is just a formula that financial institutions will use to calculate it.
Perfect. And one more came in.
Yeah.
Would that be detrimental to use additional payment amount to credit card instead of the minimum payment?
Would it be detrimental in the sense that you're paying more towards the principal? Just to confirm the question.
I believe so. Like, does it hurt you to pay, I guess, above the minimum?
No, not at all. You're getting rid of that credit card debt, which is typically at a higher interest rate. That's not detrimental at all. If it's something that's within your wheelhouse and you can do it, I would recommend doing that.
Perfect. That is all for now.
Awesome. All right. So, assessing your debt situation. So, step one, list all debts, including credit cards, loans, and personal debts. Calculate the debt total, add up all outstanding balances to see your total. List the interest rates, identify which debts have the highest interest rates. Then number four, check your monthly payments, know your monthly payments for each debt. And number five, calculate your debt to income ratio formula, monthly debts divided by monthly income times 100. So we just did this. So we did all this stuff, but I have follow-up questions for the group. Um, how often are you guys keeping track of your debt balances, and how does the tracking help with repayments? I have another follow-up question. And this one is gets typically garners a little bit more engagement. So what would it mean for you individually if you could be debt free? What could you what could you gain by gaining more control of your finances?
Freedom,
Freedom indeed. Yeah.
better sleep,
Better
better
sleep.
better loan opportunities.
Yep. Perfect. All right. Any more that come in too, just keep sharing them, Jen. I just know I want to keep pressing along here because we've had some good engagement. So I'm going to move to the next one for us.
Nice. I have just a few more. If I were
Yep.
debt free, I wouldn't be worried 24/7 about money. Thank you for
Yep.
your honesty there. And I just think we will never become debt free. And that's a fair mindset to have considering the times and someone's
Hmm.
ability to travel, which is great.
Yeah. Love those. Now, whoever said that they can't be debt free, there's a way. There's always a
Yeah.
way, and we're going to talk about how to try to help you get to that point as we go through this presentation. But I can understand that's a very, very real thing, and thank you for sharing that with us. So finding the balance. How much debt is too much? DTI benchmarks. This is a follow-up to who asked that question for DTI. Good debt to income ratio, less than 36%. Warning zone, 37% to 49%. And high risk, 50% or higher, may struggle to qualify for loans. Then signs of too much debt. We're struggling with minimum payments. We're using credit cards to cover essentials. No emergency fund. And then credit utilization. So credit utilization above 30% of your available credit is generally too high and may negatively impact your credit score. There's a formula right there for that. So total credit card balances plus total credit card limits times 100 equals your credit utilization. And we already heard a lot of people talking about the financial freedom and being able to sleep at night. One of the things that when you know you have too much debt is emotional and mental stress. Feeling overwhelmed, anxious, or stressed about managing debt can be a sign you're carrying too much. That was a lot of information on this slide. I know we answered the DTI question that came up earlier about percentages. Does anybody have other questions on this slide? Okay. So we're talking about the financial freedom. So with less debt, you're going to have more control over your money, allowing you to spend, save, or invest without worrying about debt payments. So when we think about visualing life with less debt, you can imagine the possibilities, like we talked about, more financial freedom, reducing stress, the opportunities to save and invest, improve credit score, and then achieving financial goals. And everyone tends to have a financial goal, whether it's to take a special trip with their family or friends, or to buy a home one day, or to relocate somewhere, or if there's something in particular that you've saved up money for and you've been paying off your debt before you buy it, buying something for yourself or for your family and friends. Those are some of the things that when we have less debt than are then achievable. Um, this is a pretty straightforward slide, but I just any does anyone have any questions or comments on this slide about, how their life could be if they had less debt? Or is there anything that you guys would do if you had less debt?
No comments yet, but I would piggyback off the travel, definitely.
Yeah. Yeah, well, it's one of the things, the achieving financial goals. I mean, and it could be too. There's other items there. You could be starting a business, saving for your children's education, those types of things. The improved credit score also helps you get there because you get those lower rates as we learn to, once you get out of the debt and then you learned how you did that and then you can manage it more effectively, especially with some of the tools we're going to talk about, then you're going to be able to get some of the more of those advantageous loans and items there. So, we'll keep moving forward. Setting debt management goals. So you want to use SMART goals. SMART goals stand for specific, measurable, achievable, relevant, and time-bound goals. So when we think about this, we want to define a clear goal. Set specific goals like pay off $500 credit card debt in 6 months. Then we're going to prioritize. So we're going to prioritize debts that focus on high interest debts first to save money in the long run. If they have a much higher interest rate, we're going to try to get those paid down versus something like we'll use the credit card example that we used. That credit card at 18% should be a priority over, say, paying off a car loan that's at 5%. We want to set a timeline, create a timeline for each debt payoff. So pay off car loan in 2 years or pay off credit card in 6 months, like they mentioned in the first slide there. Break it into steps. So break down big goals into smaller and manageable steps. You can pay an extra $50 per month towards your loan, and then you can see how much that's going to take off over time. And then track your progress. So track it regularly to review and adjust your goals depending on how you've progressed. And Jen, one of the activity in this one is to have someone write a SMART goal. I'm not going to ask anybody to do that because I don't want it to if nobody that has to share any personal information. But this is a really good slide for you guys once we send out the materials to, do yourself if there's specific debt that you want to pay off and know the steps to get there. Um, so from a participation standpoint, if anybody wants to share, if they're more than willing to do so, don't feel obligated to because I know that's a personal conversation.
No, yeah, definitely. I think we can skip this one, but
Yep,
I highly encourage everyone to do it in the follow-up email once it's sent.
perfect. All right, we're going to talk about debt repayment strategies as we move on to the next one. So there are three different kinds. There's a lot on this slide. So I'll start off. We're going to start from the left and go to the right. So what motivates you the most? And we'll start at the top, go down, and we'll go from there. Do you prefer seeing quick progress by eliminating smaller debts? If so, we're going to go with the snowball method. You pay off smaller debts first, quick wins to stay motivated, and then you follow with remaining debts. Do you want a mix of emotional wins and interest savings? The hybrid method. Start with small debts, then switch to high interest debts. Balance of emotional progress and financial savings. Continue with a custom approach that works best for you. And then are you motivated by saving money and minimizing interest over time? The avalanche method focuses on paying off high interest debts first to save on total interest, long-term savings and reduced interest, and pay off lower interest debts after that. That I know was a lot. Are there any methods that you guys have questions on or need clarity from this that I can, help out in that regard? And I'll just say this, I tend to find a lot of people will fall into the hybrid method where, yes, we want to try to pay off as much as we can, but also being financially savvy and making sure that, if there's things that we can pay off and it's within our wheelhouse to do so, absolutely. But knowing that some of the longer term debt, if it's some of that good debt like we talked about, knowing that that's there and paying it there. The The snowball method is very good for some small stuff like credit cards, or if you have kind of small loans, or if you financed items, things like that, just to get those paid off. And then the avalanche method is to really just try to get everything out of the way and then focus on the long-term savings of everything to really get that financial freedom.
Nice. We do have one question that came
Yep.
in, which is if we should focus on low interest debt
Mhm.
or low interest payment if all other debts are paid.
So that's a great question. I would say that it comes full circle to your financial situation. If everything else is paid and you have the ability to pay it off, that is, are you comfortable having debt? Or would you still want to focus and have it taken care of? That would fall into the avalanche method. So you would make sure that if everything's already paid off, then even though that's a low interest rate, you can pay it off. But again, things to consider depending on that type of debt. Is it a real estate loan? Is it a car loan? Are there prepayment penalties if you do that? So those are things to consider. But anytime you have the ability to put more towards debt to give you true financial freedom without any, then by all means, I would say go for it. But sometimes, say you're in a 0% interest rate for 2 years and you know you're going to pay it off in that 2 years, you're paying nothing for that and you're stretching out your money by having more in your account instead of paying it off. So it's kind of it's like a double-edged sword. It's all going to depend on your current financial situation. But anytime you can pay off debt and it's within your wheelhouse, I would recommend that.
Perfect. No more questions.
Okay. So budgeting for debt repayment. So no matter what debt repayment method we select, we're going to need to calculate the payments into your budget. So having a clear understanding of where your money is going will help you identify opportunities to divert funds towards paying off debts. So prioritizing debt repayment into your budget can help you stay on track, and there are roadmaps to becoming debt free. So one of the first things we want to do is calculate our monthly income, which we talked about earlier. So determine the monthly income from all your sources that you have. Track your essential expenses, including rent, utilities, groceries, transportation, and minimum debt payments. Then you want to identify non-essential spending. So non-essential spending, dining out, entertainment, and find areas that you can cut back in. And then allocate extra funds to debt. So use any surplus from cutting non-essentials out to pay down debt faster. And then there's the 50-30-20 budget rule. So 50% needs or essentials, 30% for discretionary, and 20% for savings and debt repayment. And you can always adjust that 50-30-20 rule to focus more on debt if you so choose, taking away from the wants category if need be. So dealing with high interest debt. So prioritize the high interest debt, like high interest debts, credit cards that can cost more over time. So focus on paying off any debt with high interest first. Consolidate them when possible. Use balance transfers or consolidation loans to buy high interest debts into a lower rate loan. Make extra payments. I know this was a question that we had talked about earlier. Allocate any extra funds towards the high interest debt to reduce the balance faster, and negotiate with creditors, which we are going to be getting to that slide in just a couple more slides. So we'll have some tips and tricks there. Um, Consolidation loans or balance transfers. Balance transfers refer to when you take a balance from a credit card and you put it onto another credit card, which will typically offer you an introductory rate to do so. Financial institutions, they're more than willing to help out and give out some of those promotional rates, so that could help you get those paid down faster. So that credit card example from the beginning, the 5,000 at 18%, if a bank or a financial institution offered you a credit card balance transfer offer to take that $5,000 and have it at 0% for 24 months, that would help you immensely by not having to pay that 18% for those 2 years to really chip away at that. Making extra payments, we had chatted about that earlier. It all there's always a great strategy to pay down high interest debt. We just want to be cognizant if there's any early payment penalties or fees or things of that nature. And then the negotiating with creditors, as we've talked about, I'm going to get into some of those things that you guys can do here in a couple slides. But before we move on, I know this one's pretty straightforward. Any questions on these four items?
No, not at the moment.
Okay. Strategies to manage debt. Credit card debt. Pay more than the minimum. Target high interest cards limit new charges on cards that have a balance, use balance transfers wisely, and automate payments. Student loan debt. Understand your loans. We had that comment earlier where someone's loan was at 6% and the industry average was 3%. So explore repayment plans, consider refinancing or consolidation, make extra payments when possible, use loan forgiveness programs, and again, automate your payments. Medical debt. Review your medical bills for accuracy. Negotiate payment plans. Check for financial assistance. Use HSA or flexible spending accounts if your institution that you work with offers those. Consider medical debt consolidation and understand your rights. And car loan debt. Again, make extra payments when possible, the automating payments, consider refinancing, avoid negative equity, and maintain adequate insurance. Is there any specific question that you guys have from any of the bullets that I just hit?
Yes, someone asked, what is the benefit of automating student loan payments?
The benefit of automating, I'd say any payment, is that you don't run into the risk of missing a payment. And there are also certain debts like student loan, medical, or car loan debt, where if you automate a payment through whatever institution they partner with, they'll sometimes give you discounts for having auto pay set up. Again, that depends on your loan and the institution. But that is one of the features that financial institutions look for is if someone is willing to set up automatic payments, that is a big factor that they look for.
Does it also impact credit, your credit?
The automatic payments?
Yeah, or payment in general?
Yeah, indirectly because you're never going to have a missed payment or late payments on there. So by always having automatic payments set up, you're ensuring that you're not going to have those derogatory marks on your credit score for late payments.
And one more, do car insurance use your credit to calculate how much your premium cost?
That is a great question. Um, I don't know. Because I don't work in the insurance industry. So I don't have that answer off the top of my head. That's a great takeaway. I mean, we can research that, Jen, and get back in the email that we send out. I don't have that answer off the top of my head, so I don't want to give you guys any misinformation. I do not know if they do a credit pull when they do your car insurance.
Definitely. We can look into that, Lisa, and get back to you.
There's one in here that I did want to give you guys the notes that I have on it. It's specifically around medical debt. The understand your rights, because I know that can be a little confusing. Medical debt cannot be reported to the credit bureaus for 12 months after the bill date. That's what understand your rights mean. So medical debt, I'll just rehash it one more time, cannot be reported to the credit bureaus for 12 months after the bill date. So just so you guys are aware of that. All right. This is the one that everybody had questions on. So contacting creditors. This is a big slide, and I know there's going to be some questions on here, but so if you're having a difficult time managing your debts, you can reaching out to creditors early can be a key step in managing debt more effectively. By opening the dialogue, you may be able to negotiate better terms and find flexible solutions to make repayments easier. So if you're prepared, know your account details, balance, and interest rates. Reach out early, contact creditors as soon as you face financial difficulties. Ask about hardship programs. Explore options like lower interest rates, payment plans, or deferrals. Negotiate terms. Try to lower interest rates or waive fees. And get agreements in writing. Always request written confirmation of any changes. So having all this info, so let's start with the first one, being prepared. Having all your information ready and showing whoever you're reaching out to try to have a negotiation shows that you're prepared, you're serious about it, and you want to make sure that you're still paying the debt, but you need some assistance. Reaching out early can prevent late payment fees, additional interest, damage to credit scores, and creditors are usually more willing to work with you if you're proactive rather than reactive when it comes to if you start to miss payments or anything. Hardship programs. Many creditors offer hardship programs that can temporarily reduce your payments, lower your interest rates, or allow for payment deferrals. Ask your creditors what options may be available, especially if you're dealing with a temporary financial setback like a loss of job or a medical issue. And negotiating the terms is exactly what it sounds like. The worst they can say is no. It never hurts to ask to try to negotiate and see how they can help you out. And the last one is very important is getting agreements in writing. So if you call in, you negotiate something, you get it in writing so you know that you have a copy of what was changed and that you have it for your records so they can't come back and say, we never agreed to that. So you save all communications, emails, letters, everything. So having all that goes a very long way. So open communication with your creditors can lead to more flexible situations, and being proactive is one of the best ways to manage debt effectively. I'm going to pause there. I know that was a lot of information. Any comments or questions?
No major questions or comments at the moment.
Okay. Debt relief options. So they can provide ways to manage overwhelming debt, but each comes with its own set of pros and cons. It's important to choose an option that aligns with your financial situation and long-term goals. So debt consolidation combines multiple debts into a single loan with a lower interest rate, simplifies payments, and potentially lowers monthly payments and interest rates. Requires good credit to qualify for favorable terms. Extending the loan term could mean paying more in interest. Debt settlement. Negotiating with the creditors, settle the debt for less than what's owed, can reduce the total amount of debt and provide relief faster, can negatively impact your credit score, and forgiven debt may be taxable. Creditors may not agree to settle. Credit counseling. Work with a nonprofit credit counseling agency to create a debt management plan. Professional guidance and support in creating manageable repayment plan, often with lower interest negotiated on your behalf. You must close your credit card accounts and make a single monthly payment to the agency, and it can take several years to complete. And bankruptcy, a legal process to either eliminate or restructure debt. Can discharge most debts or set up repayment plan offering a fresh financial start. Severe impact on your credit score, stays on your credit report for up to 10 years, and can make it harder to obtain credit in the future. I'll just say too, before we move on from this slide, as we saw from the last bullet, each of these options can be extremely helpful to you to get debt free, but they have trade-offs. So you want to make sure you carefully evaluate which one best suits your financial situation and what your goals are. So just take that into consideration when looking through these options. All right, strategies for staying debt free. So biggest thing, planning, discipline, and consistency. So those are the three big ones. So create the monthly budget. We want to build an emergency fund, limit credit card use, pay bills on time, live below your means, and set financial goals. So creating a monthly budget, sticking to a budget that tracks your income and expenses, and savings to avoid overspending. Building an emergency fund. Set aside money for unexpected expenses so you don't have to rely on credit. Limit credit card use. Use credit cards sparingly and only for purchases you can pay off in full each month, meaning you can pay off the balance of the credit card in full. I'm sure we have some people in here that use credit cards as their daily spenders and pay the balance in full. That's a great way to earn rewards and do it that way, but just making sure that if there is any type of financial disruption in your life, that we then go back to setting the budget and using the debit card, not the credit card, because it can be a slippery slope for that balance to build. Paying their bills on time. So set reminders, or like we said, the automated payments to avoid late fees and interest charges. Live below your means. Avoid lifestyle inflation by keeping your expenses lower than your income, even as you earn more. And last one, setting financial goals. Establish short and long-term financial goals to stay motivated and focused on maintaining a debt-free lifestyle. Any comments or questions on any of those strategies to stay debt-free?
No, someone said great information.
Mhm.
Um, Please, we still have a couple of minutes left, so keep your questions coming. Um, yeah, we will be here to answer them. I have a few closing slides, if that's
Yeah, I'm
okay.
gonna. I have. I was just gonna go. This is the last slide for you guys.
Oh,
You'll have
perfect.
this. We're sending out this PowerPoint to them, correct,
Yes.
Jennifer?
Mm-hmm.
Perfect. So you guys have resources right here. And the last thing that I would just say is, debt is temporary. The actions that you guys take today and moving forward can shape your financial future. There's all these different things like we covered that can help you get out of the debt that you're in and get you to the point where you want to be to start to achieve the financial goals that you want. And there's plenty of people here that, are more than willing to help, whether it's at your local bank that you bank with, those counseling agencies, or even any of the nonprofit organizations that you can work with as well that are more than willing to help with this. Everyone is here to try to help another person. That's why we're here, is to work as a community. So don't feel if you start to feel that it's overwhelming you, reach out, set your goals, and there'll be someone there to help you. And that's what I have for you guys. And I really appreciate you having me. And I'm here for any additional questions or anything that we need. I'll kick it back over to you, Jen.
Amazing. Thank you so much.
Yeah.
Just a few more slides, but thank you all for your questions. Um, it was pretty amazing, and thank you for sharing. Debt is such an important topic to talk about overall, so I'm glad that we were able to touch on that today. Oops, one second. Okay, so if you could see my screen, next week, rounding up one of our last few seminars for the Worth and Wealth season this fall, is retirement ready. So building your path to financial freedom. So this will talk about all about retirement, 401ks, Roth IRAs, all of the things. So please join us for that as we think a little bit more about our financial future. And lastly, as always, you have 1 free hour of financial coaching with Samantha Morales. You can scan the QR code, but the link will also be in the email. I believe she still has some spots available for November, but we will continue coaching for next year as well, just not at the same level of availability. So definitely take advantage of that. And lastly, our financial education platform, Enrich, where you can find anything from blog posts, mini courses, activities. I mean, you name it, it's there, all regarding financial topics, including debt reduction. So definitely check it out if you want more on-demand resources when it comes to financial education.